Welcome back, my people, to yet another very important video in which I'm going to simplify, actually, through my own perspective, how to understand your bias and your narrative and draw on liquidity. But first, I want to speak of something over here. If you can see right there, it's a picture of like a depiction of a candle, all high, bearish FVG, all low, and a bullish FVG right there. Okay. Now, if you want us to understand, and if you ask in any particular day that I want to sell, like you want to sell, there are only two ways you're going to sell: above old highs, all highs. All right, remember this: all highs. It can be previous session high, it can be a previous day's high, previous week's high, previous month's high, previous year's high. All right, any previous liquidity. It should be timed as well. Remember this: it cannot be any random stupid wick which pops above and then you're gonna sell. No, it should be timed. And then this turtle soup above the old high, you have to sell. It also has to be timed. So before understanding the bias, you have to understand when to sell, the time, which are mentioned in my previous videos. So go through those videos as well. Now, you want to sell? Keep this in your mind, engrave it, and write it down 10 times that if you want to sell, you're going to sell at old highs. Not here, not in the middle, above old highs. Or if a setup forms, right towards the old high. All right, you're going to sell at the old high and then target below. Next option is bearish FVGs. Your bearish FVGs right there. All right. It should be timed as well. This FVG should be an important FVG, not just some random ass FVG which you take out after learning few ICT concepts. No, you have to understand time. You have to know the narrative, because this can be a fake FVG as well. All right, because it will turn up and then it will become a balanced price range, and then it's flipped and it's bullish. Yeah, so you have to make sure that the order flow, the higher time frame order flow, is bearish firstly. Then what's the higher time frame order flow? Your daily order flow. If your daily is bullish, you're gonna have to long. Where do you long from? Below old lows, you have to long. Now you might say this is very basic. It's just some boring bullshit which I'm speaking of. It's like every single one says the same thing. All right, then why aren't you following? If that's the case, because I'm seeing people, and I'm seeing a lot of videos as well, which says do this, do that, and then internal liquidity, external liquidity, which works because the algorithm targets either internal, which is FVGs, and external, which are the old highs and lows. But that's the whole point. You have to buy below old lows. You have to buy at bullish FVGs. So any time when you go on the chart, you have to look where you are in price. All right, not in time, in price, where you are. And then when you want to take a trade, you have to check where you are in time plus price. So if both the things are not aligning, you don't have a trade. All right, it can be $1 million trade, but it will be gambling if these two things are not aligned. So where you are in the market, if you are in the middle or somewhere, all right, right there, you are over here, just imagine. Okay, because it's a possible scenario. You're right here in the market, because the time you hopped onto the charts, the price is hovering around somewhere here, not above, not below, over here. You don't have a bias now. What do? Oh, you're gonna panic. You're gonna punch the screen. You're gonna kill yourself over this one scenario which is playing out in front of you, that you don't have a bias. In that scenario, you just simply wait. You wait for the market to play its card. You let it play. It can be a possibility that instead of in this price range, instead of going below, taking the old low, it might just reverse. It might. Then again, it's you're not at fault. The market is not at fault. It's just how price books. You cannot fight with this thing. All right. And one more thing I want to mention. Make sure you listen to it, and it's very crucial in my experience as well, that in a day when I come to the market, okay, and I come to the market on the right time. Let's suppose I come to the market in the London kill zone. All right, listen to this. I come to the London kill zone and I do not know what the fuck is price doing. I don't know what the hell is going on. At that time, do I blame myself for not knowing the bias? At that time, do I blame and regret that I do not have enough knowledge for the markets, and I want to go look for more videos on YouTube and then come back to this same chart and then have have an idea of how to read prices, and then the very next day I have no idea at all, and then the cycle continues? In such days, what do I do? In such days, I have learned actually to let it go, let the charts go, even if there are like three different setups forming in front of me. There is a breaker, a unicorn pattern, this, that, everything's forming. But if I do not understand this, that I have to buy below all lows and sell above all highs, right? If I do not have this scenario in the market, I just leave it. I don't touch it, because preserving your capital and your mental capital as well is really, really important than taking the trades. All right. So if you do not have an idea where you are in the market, just let the market go. Let yourself go. Go relax with your family, or do something else. All right. Or just come and watch this video. I'm kidding. So you buy below all lows. You buy daily FVGs, bullish FVGs. It can be a daily, it can be a 4 hour, 1 hour, 15-minute FVG, anything. It can be a 4 hour low, it can be a daily low, it can be a monthly, weekly, 5-minute, 15-minute, for anything, 1 hour, any low. All right, timed low. You're gonna have to buy below this. Now, how do you know where price will go? Is it gonna go bullish or bearish? All right, wick above with this body at a certain level and a certain time. Know this: certain level and certain time. Time I have already explained in my previous video, so I say that once again. Go watch and learn. At a certain time and a certain level, wick above, lower prices. Know this very clearly. Lower prices meaning what? You're gonna have to target this low. This is the whole idea. Now, it does not mean that this 5-minute candle, it can be a 5-minute candle, okay, and you just have to target this low. No, there is a whole, that's the whole narrative. All right, because there can be a candle over here like this. There can be a range like this, okay, right there. That's your range. Okay, 1 second. Range has formed. This candle has turtle souped this high, close below, and this is a close below, wick above, lower prices. You understand? This is your narrative. Your drawn liquidity is the other side, the opposing range. This is your drawn liquidity. I'll give you an example right there. This is the open, high, low, and close. Let's get back to it in a while. See, this is your whole idea of the trades. This scenario right here, which I'm presenting to you, this is the whole idea. Daily key level, 4 hour range, any particular 4 hour range at certain times, okay, like 9 a.m., 5 a.m., 9 p.m., or in case of indices, 2 p.m., 10 p.m., all these ranges, 4 hour ranges. Daily key level, price closed above, wick below, higher prices. No, objectively know this, that the prices are going to go high. Now, this thing is your narrative. What's your narrative? This range low, smart money has taken this low, and the price is going to have to redeliver in order for the the other side of the liquidity to be taken. Where are the stop losses of these lows or these cells? Right here. All right, so it's gonna hunt the other side of liquidity. Okay, now that's your narrative. That's why you're gonna take a trade over here. Your pattern and everything shall be forming over here. This is your drawn liquidity. All right, and this is your bias, higher prices. Second scenario, 4-hour range, close below. Close below, immediately this low right here. All right, this candle's low, because it closed below. This candle's low should be your drawn liquidity right there. Now let me tell you something. There is a possibility that you do not find any setups over here in the 15 minutes the 50% of this range, this big ass range over here. All right, this range 50%, you will not be finding any kind of setups or turtle soups or whatsoever. Nothing over here. There's a possibility, but still it hits your drawn liquidity. Then what do? Again, you're gonna punch the screen because you missed a really good opportunity. All right, and your drawn liquidity was hit, your bias and everything was correct. Are you gonna regret? Are you gonna like pull your hair and shoot yourself or something? No, you just simply wait for the another opportunity. This thing is gonna keep forming again and again. You just wait for it. Don't be jumping here and there. Don't be paranoid about it. And this right here is how this candle right here, this one, look, it opened, accumulation. This is quarter one, accumulation, fake manipulation, first fake manipulation, actual manipulation, quarter 2, 3 and 4. This is the manipulation low. Candle goes below the open. Buying below the open is recommended. Make sure that you buy below the open of the candle, of the daily candle, 4-hour candle, 1-hour candle, whatever. Buy below it. Buy below the open. Sell above the open. All right, over here there will be always a turtle soup. Always keep an eye on it and study about it. And this is your very low risk entry. Actually, this is the OTE, or the third candle, which is the expansion, the fastest one right there. So this one is your range. This is your range. This right here, turtle soup, and the entry is your narrative right here. And this all the way expansion is your bias. All right, and this is the close. Now, where do you sell? Once again, you sell at all highs, you sell at bearish FVGs, you buy at all lows, you buy at bullish FVGs, timed FVGs, timed lows, timed FVGs, timed highs. All right, and wick above, lower prices, wick below, higher prices. Now higher prices in terms of the next candle will be forming a high, meaning the next candle is going to hunt the stop losses above this candle's high. That's the whole idea. You understand this? It does not mean that the market, after this candle is like this wick below, the market is going to go like this. No, it means the next candle is going to hunt up, is going to book higher prices. That's it. You have to make sure what's going to be the next candle. All right, possibility is this kind of pattern might be forming at an extreme high right here. All right, and then the prices might redeliver to lower prices, like lower levels. So you're saying, okay, this pattern failed, look, at the high this candle formed and then it did not go above. The idea is lower prices with this wick below. Okay, once we have this candle like this, the idea is the next candle is going to hunt for the highs above this candle. That's it. That's the whole scenario. And then you build up a story like this around key levels. Okay, around key levels, and with a proper understanding of lower time frame price action. That's your pattern, which is model 1, kiss of death. It can be a unicorn pattern, it can be a 2022 model, anything, whatever you choose, whatever works for you. But this works for me, and I'm gonna follow this. So that was a long video, and it was a mouthful of information actually. And if you still have more questions about this, anything which you want to ask me in the comment section. Join my Telegram as well. I speak of I'll speak on behalf of all of you, and I'm listening to you. If you have any feedbacks as well, do comment, and I'll see you in my next video. Good luck and good trading.